Imagine you are sitting at a high-stakes poker table with one of the most famous contrarian investors of our time.
Right, the chips are stacked high.
Exactly. The tension in the room is thick. And right before he cashes out, leaves the casino, and just goes completely off the grid, he pauses.
Oh, I love this analogy.
Right. He looks right at you, and he flips his cards over. He shows you his final hand.
I mean, it is the ultimate parting gift for anyone who's actually paying attention. A clear look into the mind of someone who has, historically seen what the rest of the market completely missed.
So today, we are looking at the Q3 2025 Form 13F for Michael Burry's Scion Asset Management. And for those of you tracking the industry, you know this is a massive milestone.
Yeah, it really is. It's the final regulatory snapshot before Scion formally terminated its SEC registration back in November 2025.
Exactly. He's moved his insights strictly into the shadows now, to his independent Cassandra Unchained commentary, meaning this is it. This is his final public footprint. We have a stack of forensic financial analysis detailing this portfolio. And our mission today is to decode his ultimate two-tiered investment architecture. So, okay, let's unpack this.
Well, we really have to approach this document with the right lens. I mean, this isn't just a list of stock tickers to blindly copy.
Right?
It is a window into a highly specific forensic accounting philosophy. It's honestly a masterclass in modern value investing. The architecture here is what really stands out because we are looking at a deliberate, extreme bifurcation of capital.
I look at this structure and I just see a financial barbell.
Yeah, that's a good way to put it.
On one side of the barbell, you have this massive $1.38 billion notional derivative book that is heavily shorting the artificial intelligence boom.
Which sounds crazy at first glance.
Yeah, it's like holding a high-stakes, defined risk insurance policy on your entire neighborhood burning down.
And then you look at the other side. You have a heavily concentrated direct equity book of just $68.1 million, parked in four completely unloved, boring businesses.
It's like sticking your life savings into a hyper-conservative, cash-flowing mattress.
Exactly. And if we connect this to the bigger picture, what you are really looking at is a modern adaptation of Benjamin Graham and David Dodd.
The classic value investing fathers.
Right, but adapted for today's hyper-fast, complex markets. I mean, this strategy doesn't just screen for cheap stocks using basic price-to-earnings ratios. It hunts for a quantifiable margin of safety that's driven by extreme, often completely unjustified market pessimism.
So he looks for the panic, but he doesn't just buy because people are scared.
No, not at all.
He verifies that the panic is irrational by doing the exhausting line-item forensic reading of the 10K footnotes.
Yes.
He's looking for hidden vulnerabilities or hidden strengths long before standard GAAP earnings actually reflect them.
Because the standard accounting rules often mask the physical reality of a business. To really understand how this forensic analysis works in practice, we need to first examine where he parked that $68.1 million, the mattress side of the barbell.
Let's talk about catching falling knives with durable cash flows. Starting with the two largest direct equity holdings, which are Molina Healthcare and Lululemon.
Right.
Molina represents 35% of this equity book, and Lululemon is 26%. So, more than half his cash is in just two companies that Wall Street essentially abandoned.
Molina Healthcare is a perfect starting point here. It's a managed care organization mostly dealing with government-sponsored programs like Medicaid, and the market just absolutely dumped this stock.
Yeah, big time.
The share price dropped 34%, and the shares in this portfolio were acquired around $191 a share. That implies a wildly depressed 0.2 times price-to-sales multiple. I mean, you are paying pennies for every dollar of revenue they generate.
But the market panic wasn't totally imaginary, though. I mean, the data shows Molina's medical care ratio spiked up to over 89.1%.
Right.
And for anyone unfamiliar, that ratio is basically how much they spend on actual medical care versus what they take in from government premiums. So a higher number means squeezed profits. And this spike happened because of post-COVID Medicaid redeterminations. States started kicking healthier people off the Medicaid rolls, which leaves Molina with a sicker, vastly more expensive patient pool. So the margins just collapsed on paper.
They collapsed, yes. But here is the forensic insight. This is the underlying mechanism the market algorithms completely ignore.
Okay.
State Medicaid rate setting doesn't happen in real time. There is a structural 18 to 24-month lag.
Oh, wow. So they're just waiting on the government.
Precisely. State actuarial boards need time to process all this elevated claim data, run their own models, and then revise the capitation rates upward to match the new reality of the medical costs.
Yeah, so it's a bureaucratic rubber band effect. You get stretched thin while the state does its paperwork, but eventually the rates have to snap back up to cover the actual cost of care.
Exactly. And once those rates adjust, Molina's normalized operating margins will return to their historical 3.5 to 4.5% range. When you run that margin against their massive revenue base, the math dictates an unlocking of $18 to $21 in earnings per share.
That's huge.
Right. The market is pricing the stock as if the temporary margin squeeze is permanent.
And I guess the margin of safety here is that they aren't going bankrupt while they wait out this 18-month lag. I mean, they are sitting on $8.3 to $8.9 billion in cash against just $4 billion in debt.
Yes.
They're a financial fortress. You basically just buy the dip and wait for the government paperwork to catch up.
The structural safety in the balance sheet is key. And we see a similar theme with the second major holding, Lululemon. This is a fascinating play because of the sheer conviction involved.
It really is. I mean, he doubled down. He increased the position by 100% up to 100,000 shares. And this is while the stock was basically in free fall.
Dropping 50% from its highs.
Right, due to slowing North American sales and some heavily publicized inventory issues with their color palettes. But I have to play devil's advocate here, though.
Go for it.
Consumer trends are incredibly fickle. People can just buy cheaper athletic wear from emerging competitors on Instagram or TikTok now. Why step in front of this specific falling knife when the apparel industry is notoriously unforgiving?
It's a fair question, but the answer lies in the undeniable structural math of their specific business model. When you lift the hood on Lululemon, you find zero long-term debt.
Zero.
Literally none. And they are sitting on $1.5 billion in pure unencumbered cash.
Okay, that is a massive safety net for an apparel brand.
Beyond the safety net, it's the capital efficiency that separates them from standard mall retailers. They maintain an adjusted return on invested capital between 35 and 42%.
That's insane.
That is astronomically high. Every dollar they put back into the business generates a massive return. And while everyone was panicking over the North American sales slowing to 4% growth, the market entirely overlooked their growth in mainland China, which was compounding at over 30%.
And the pricing power is what really validates that return on invested capital, right? Because traditional sportswear brands sell through massive department stores.
Yeah.
They are entirely at the mercy of that retailer deciding to mark down prices by 40% just to clear the racks at the end of a season. It kills the brand prestige. But Lululemon controls over 90% of its sales directly to the consumer.
They own the entire transaction. Because they operate that direct-to-consumer model, they never have to heavily discount to save a middleman's margins. They keep their premium pricing power intact, which is what drives their retail store productivity to an absurdly high $1,600 per square foot.
Wow.
Yeah. The brand is a cash-generating machine that the market temporarily priced like a dying legacy retailer.
So Molina and Lululemon are both classic deep value plays on temporary operational hiccups. The market overreacts to short-term data. The forensic math proves the underlying business is incredibly safe. You simply wait for the normalization. But the next two equity plays on this barbell are structurally different. We're moving away from operational turnarounds and looking at sheer financial engineering, capital structure arbitrage. Let's dig into SLM Corp., better known as Sallie Mae and Bruker Corporation.
Sallie Mae is a masterclass in finding deep value in an actively despised sector. The position is substantial, over 480,000 shares. And they dominate the private student lending market with over 50% market share.
But mentioning student loans to any investor right now sets off alarm bells. I mean, the political headlines are entirely focused on loan forgiveness, massive default rates, and regulatory crackdowns.
That is the macro public narrative, for sure. But the forensic reality of Sallie Mae's specific private portfolio tells an entirely different story. They operate with an incredibly conservative underwriting profile. Over 90 to 93% of their new originations require a cosigner.
Right, so a parent or guardian with actual assets is legally on the hook if the student defaults.
Furthermore, the average FICO credit score at approval is over 750. Their credit quality is pristine. Despite the scary headlines, their loss reserves are aggressively padded. But the real magic here is how management is allocating their profits. It is what we call capital cannibalism.
Wait, explain that.
Between 2020 and 2025, Sallie Mae retired an absurd 52% of its total common shares outstanding.
They bought back more than half of their own company in 5 years.
Yes, if you owned a slice of this pie in 2020, your ownership stake has effectively doubled without you doing a single thing.
That's wild.
The mechanics of those buybacks are what make it a masterstroke. They are buying those shares back at single-digit price-to-earnings multiples. Meanwhile, the underlying business generates a return on tangible common equity of over 20%.
So for the listener, return on tangible common equity essentially means looking at the pure, hard, physical cash and assets the company holds,
Yeah.
subtracting the fluff like goodwill, and seeing how much profit they generate from it.
Right.
Generating over 20% on hard assets while trading at a single-digit PE is incredibly rare.
It's a compounding machine hiding in plain sight. The valuation is artificially depressed by macro-political noise about federal student loans that fundamentally doesn't impact their pristine private loan book.
Which brings us to the fourth equity position, Bruker Corporation. And this is perhaps the most elegant move in the entire portfolio.
It's brilliant.
Earlier in the year, Burry held 250,000 shares of Bruker common stock. But in this final 13F filing, that common stock was entirely liquidated. He swapped that capital into 48,000 shares of Bruker's 6.375% Series A preferred stock.
Yep.
Think of it like moving from a highly volatile coach seat into first class on the exact same airplane during extreme turbulence. You cap your upside. You aren't going to get rich if the stock rockets to the moon, but you get a guaranteed 6.375% drink service, and you get to get off the plane first if it crashes.
That is a perfect analogy. It is a textbook capital structure arbitrage. Let's look at the company itself. Bruker has a massive economic moat. They operate a near-monopoly duopoly in highly specialized scientific instruments. We are talking about multi-million-dollar nuclear magnetic resonance and mass spectrometry equipment.
The heavy machinery that university research labs and global biopharma companies absolutely require to function.
Exactly. The problem for anyone holding the common stock is that the biopharma industry is currently slashing its research and development capital expenditures. Interest rates are up, funding is tighter, so labs delay buying new million-dollar machines. That creates massive volatility in Bruker's standard earnings.
So by swapping into the preferred stock, you completely insulate yourself from that earnings volatility. Preferred shareholders sit higher up the capital ladder.
Right, they have senior dividend claims.
Yeah. As long as Bruker doesn't go completely bankrupt, and with gross margins sitting around 50%, they are highly solvent, you collect your guaranteed yield. You strip out the downside risk of the common equity while remaining parked in an elite life sciences franchise.
It is the ultimate defensive posture. You secure rock-solid cash flows and dividends across 4 uniquely insulated businesses. But these businesses do not exist in a vacuum. A market crash will still drag down their valuations temporarily. So to protect against the broader market euphoria, the portfolio pivots to the dark side.
Here's where it gets really interesting. We have to talk about the $1.38 billion elephant in the room.
Oh, yeah.
The massive asymmetric derivative bets against the AI boom. The filing shows 5 million put contracts on Palantir and 1 million put contracts on NVIDIA.
Before anyone assumes he bet $1 billion against tech, it is vital to contextualize that $1.38 billion figure. That is the notional value. It represents the total value of the underlying shares controlled by the option contracts. The SEC requires it to be reported that way, but the actual capital at risk, the cash paid out of pocket for the option premiums, was only about $9 to $10 million per position.
So the downside is strictly capped. He's risking $10 million to potentially make an absolute fortune if the tech market corrects. But the obvious question is, how can you possibly short NVIDIA when artificial intelligence is structurally changing the global economy? Every major tech company on Earth is buying their chips as fast as they can produce them. Isn't betting against that a widowmaker trade?
What's fascinating here is that the thesis isn't actually about the technology failing. He isn't shorting the capability of AI or suggesting the chips don't work. He is shorting the accounting.
Wait, break down the mechanics of that. How do you short accounting?
It comes down to how the biggest buyers of these chips, the hyperscalers like Microsoft, Meta, and Amazon, are recording these massive purchases on their corporate balance sheets. When they buy billions of dollars worth of AI data center servers, they don't expense the entire cost immediately. Under standard rules, they capitalize it under property, plant, and equipment, and they depreciate it over what's called its useful life.
That makes intuitive sense. You buy a massive asset, you use it for several years, so you spread the cost out over time on your profit and loss statement.
The forensic red flag is that over the last few years, to artificially boost their GAAP operating income, these hyperscalers have been quietly extending the estimated useful life of these servers.
Really?
Yeah, they moved the depreciation schedule from 3 years back in 2020 all the way out to nearly 6 years by 2025. By stretching the schedule out, you drastically lower your annual expenses, which magically makes your current profits look far higher to Wall Street.
But wait, NVIDIA releases a new, exponentially faster chip architecture every single year.
Yeah.
They went from Hopper to Blackwell to Rubin in rapid succession. And the new chips are so vastly more energy efficient that it actually becomes a financial liability to run the older, power-hungry servers.
Exactly.
They're physically making their own hardware obsolete annually.
That is the massive structural contradiction this short position targets. You have corporate spreadsheets claiming these massive server farms will be economically viable for 6 years, while the physical reality of the silicon market renders them obsolete in 12 to 18 months.
So the spreadsheets are completely disconnected from the physics of the data center.
Yep.
So if a company is sitting on billions of dollars of outdated servers that they are pretending have 4 years of life left, what happens?
Well, the forensic calculation suggests this accounting mismatch is currently hiding roughly $176 billion in depreciation across the broader tech industry. It is overstating corporate tech earnings by roughly 20 to 27%. When physical reality finally forces these companies to write down those obsolete ghost assets, the earnings collapse will be violently sudden.
It is a direct parallel to the Cisco fiber optic bubble in the year 2000. People were laying millions of miles of dark fiber, assuming the accounting would hold up, until the overcapacity caused the entire sector's valuations to compress overnight.
Exactly the same playbook.
He isn't betting that AI goes away. He's capturing the inevitable valuation compression when the capital expenditure cycle slows down and reality catches up with the deferred accounting.
And to perfectly balance the strategy, the derivative book wasn't exclusively shorts. There were also strategic long call options on Pfizer and Halliburton.
Which again relies on that concept of convexity. You'd use cheap call options to get defined risk upside in totally unloved sectors without tying up your precious equity capital.
Right.
With Pfizer, you get exposure to a post-COVID pipeline turnaround and a massive dividend yield. With Halliburton, you capture the upside of a global deep-water drilling cycle without having to actually own incredibly volatile energy stocks in your main portfolio.
It provides highly leveraged upside with strictly limited risk. It is paired perfectly with the extreme defense of the cash equities.
We have the full picture now. Extreme defense in the cash equity mattress on one side, extreme calculated offense in the derivative book on the other. So what does this all mean for you, the listener? How does this philosophy stack up against, say, the godfather of value investing, Warren Buffett?
It is a profound divergence in execution. Both stem from the original principles of Graham and Dodd, but they are built for entirely different temperaments and market realities. Buffett is looking for permanent ownership. He wants wide moat compounders that he can buy and hold for decades, and he generally avoids shorting altogether. If the market gets too frothy, he will simply let his cash accumulate and wait.
Whereas this portfolio architecture is actively hunting for what you might call roadkill value.
Tactical holds. The strategy involves buying cyclically or operationally impaired companies at steep tangible discounts, holding them for maybe 3 to 36 months until the market wakes up and the intrinsic value normalizes, and then aggressively exiting. And, crucially, it actively deploys convex derivatives to exploit specific, identifiable accounting anomalies and market bubbles while they happen.
It really is a masterclass in reading the footnotes most people ignore. Before we wrap up, if you want to access more advanced research, follow these gurus' latest movements, and leverage the latest Deep Values agents, you're welcome to download the Deep Values app from the App Store.
And if you want to track stock market temperature yourself, welcome to download the iOS app Buffett Indicator from the Apple App Store or Bubble Watch from Google Play.
Awesome tools. Just a quick reminder, you should know that all our analysis today is based entirely on publicly available sources and may be subject to revisions or differing interpretations. All content from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Always conduct your own due diligence before making investment or financial decisions.
Absolutely. And as we look at this final public filing, it leaves us with an incredibly provocative thought. Scion Asset Management is now closed to outside capital. The SEC registration is terminated. The 13F filings are a thing of the past.
Yeah.
As this deeply forensic mind moves strictly into the shadows of independent research, we have to wonder what other massive accounting illusions in the broader market are hiding in plain sight right now.
You're at the poker table. The cards have been shown, but the game in the broader market is still going. What happens when the physical reality of the world finally catches up with the spreadsheets? Keep your eyes open. Until next time.